Hello and welcome to the Business Standard Morning Show. I'm Dibarghe Sanyal. It's the 16th of June 2023 and here are the questions we'll be answering today. What course correction does the PLI scheme need? Why are millionaires deserting India? Can Indian markets stay immune to US Fed's hawkish pause? And what are dark patterns? The Centre's Production-Linked Incentive or PLI scheme, which seeks to incentivize manufacturing in India by providing fiscal stimulus, seems to have run into problems. The government is reportedly planning to hold a first-of-its-kind meeting later in June to address implementation issues being faced by producers under the scheme. Moreover, government sources have indicated that out of the 14 sectors under the scheme, the ones where progress has been sluggish may see a course correction. So, what changes does the PLI scheme need and why? Bashwar Kumar speaks to experts to find out.
Production-linked incentive or PLI schemes in sectors that have seen little progress could reportedly see a course correction going ahead. On June 13th, government officials said that the centre would weigh in on the matter, and a call on what needs to be done is likely to be taken by the end of FY24. So, let's look at which sectors need the most attention. According to data collated by the Department for Promotion of Industry and Internal Trade, or DPIIT, out of the 14 sectors under the scheme, incentives have been given to PLI beneficiaries in 8, including mobile manufacturing, IT hardware, medical devices, telecommunications, and drones. However, progress has been sluggish in the remaining 6, which are the steel, textile, battery, white goods, solar photovoltaic, and automotive sectors. Beneficiaries from these sectors are yet to receive incentives. We also need to look at what the numbers tell us. Claims under PLI stood at 3,420 crore rupees in FY23, of which the government paid 2,874 crore rupees to beneficiaries. In essence, 1.4% of the 1.97 trillion rupees allocated for 5 years towards the scheme has been paid by the government as incentives. PLI schemes were first introduced in March 2020 and targeted 3 specific industries. Government officials point out that PLI schemes for separate sectors have started at different times and are progressing at different speeds. Incentive payouts are expected to peak only in the second and the third year for each scheme. As production increases, the support given by government is also likely to increase. In fact, the disbursement of incentives is expected to be about 13,000 crore rupees in this fiscal. Against this backdrop, DPIIT Additional Secretary Rajiv Singh Thakur has said that to utilize the 1.97 trillion rupees earmarked, the current fiscal year and the next will be crucial. This is not to say that the PLI concept has not had its successes, with Made in India iPhones being the most conspicuous example. Coming back to the possible tweaks in the scheme, DPIIT Secretary Rajesh Kumar Singh has said that the government will have to look at course correction in cases where disbursements are low and relaxations will be needed in case firms are not able to meet the threshold. On June 27th, there will be a review meeting with stakeholders, which will focus on the 6 sectors where the scheme has been sluggish. But before we get to what course correction may be needed, we need to understand why some of the PLI schemes have seen progress.
All the PLIs that concern the electronic sector, including the white goods sector, we found that there are actually 16 variations of the PLI available. And across these 16, you will see that if you look at 2 parameters, the investment to the turnover ratio varies from 6 times to 25 times. So in a mobile phone, if you put in 1,000 crores, you can get a turnover of 25,000 crores. In an IT hardware, it's from 100 crores to 600 crores, right? If you look at the same figure from a investment to the PLI incentive ratio. So if I put in 1,000 crores, how much do I get back from the government? You'll be surprised that in some areas it's as high as 25 times. In the new PLI for IT, it's as high as 20 times. But on an average, or not on an average, but the rest of them are all about 6 times. So what is happening is PLIs have worked very well wherever the investment required is not so high and the turnover to investment ratios are very favorable.
Against this backdrop, what specific course corrections do the PLI schemes need to improve the outcome.
If I were to now look at what can be done, move from assembly to manufacturing. What does this mean? This means that the investment levels are going to be higher compared to the turnover, and hence the incentives need to be much higher as a percentage. The second bit is that deep down manufacturing is not done by very large companies. It is normally done all over the world by SMEs. The current PLIs have, if I have one criticism for them, they ignored the SMEs completely. So fair enough, as phase one, you said, let's do the large assemblers first, large companies. Now as phase two, I think we have to look at how can we get the SMEs involved in this whole process. So the thresholds for investment will be low. However, given the nature of their business, the investment to turnover ratios will still be low, which means that the incentive has to be more than the 3, 4, 5% that we are getting at the moment. Second part is that obviously we cannot have it a very high incentive. So, and components or deep down manufacturing does not give you money within 3, 4, 5 years. That happens in assemblies. So if you want serious manufacturing to happen, your gestation periods are longer. So instead of a 4 or 5 year policy, give a 7, 8, 9 year policy. Third, value addition can happen through technology. So we need to have either design or a technology-led incentive.
So if you ask me, in textiles, we struggle with basic competitiveness issues. In steel, we have a very successful steel industry, which is exporting in any case around the world. And maybe the gestation period is longer in terms of investments. So perhaps we just have to wait a bit. In solar and photovoltaics, it's a much tougher sector. There are huge entry barriers. China is way ahead of everyone else in the world, not just India, but way ahead of everyone else in the world. To really make a play there is going to take a lot of effort and work, and probably needs a lot of close interaction between government and the particular industry sector. So hopefully those approaches and way forward will emerge from the discussion that the government has together with the specific industry sector. I think the answer will be different for the different sectors. If you ask me, one of the key concerns I have about the PLI scheme is I'm not sure it has enough of focus on technology, and that it's driving enough investments in technology by firms in the here and now, so that when the PLI scheme goes away, when the subsidy goes away, the firms can compete in the long run.
More clarity is required on the incentives that firms are supposed to receive, and there should be no difference in understanding between the government and manufacturers. Documentation issues also need to be ironed out. Ultimately, experts say the peculiar requirements of different sectors need to be understood for the PLI scheme to achieve its full potential.
She'll soon be quoted on the front page. Business Standard.
The detailed analysis and subsequent course correction for the 6 sluggish sectors under the PLI scheme would help in better utilization of fund allocation over the next 2 to 3 years. While India Inc. is striving to strengthen its industrial base, a significant number of Indian millionaires have been relocating abroad of late. Though the Indian economy is growing at a faster rate and creating more high net worth individuals, the private wealth migration is a matter of concern. So, why are the HNIs leaving India? Tariq Ahmed's report traces the migration trend.
India is projected to see a net outflow of 6,500 high net worth individuals or HNIs in 2023, indicates the latest Hanley's Private Wealth Migration Report. In fact, data from Global Wealth Migration Report, Morgan Stanley and Henley reports indicate that approximately 50,000 HNIs have left the country between 2014 and 2022 period. Currently, India has the second highest HNI outflow in the world after China. A person with a net worth of $1 million or 8.2 crore rupees is considered a high net worth individual. A person with a net worth of $30 million or approximately 246 crore rupees is considered an ultra high net worth individual. According to real estate consultant Knight Frank, currently there are 7,97,714 HNIs in India. The number is projected to go up to 16 lakh by 2027. According to the same report, currently the number of UHNIs in India is 12,069, which is expected to cross 19,000 by 2027. Though India is home to a healthy number of millionaires and their numbers are going up, roughly 2% of HNIs have been leaving the country every year. But what is driving this exodus?
From an internal perspective, I think that, the tax structure in India, the foreign exchange regulations around how you can send money out, these are complex, things which bother a lot of high net worth individuals. And even as lawyers, we are getting queries from, high net worth individuals on how they want to, take out the money abroad, what they have to do to, make overseas investments. They feel stifled that the money that they have earned, they are not allowed to spend it in the manner that they want, and that there are restrictions around that. Not only are they paying heavy taxes, but how and what they will do with the money, what they can or cannot do with the money is being controlled or regulated by the government.
Political stability, low taxation, and individual freedom are some of the important factors for the ultra-rich when considering where to live. India's higher tax rates and complex rules related to outward remittances have triggered HNIs to migrate out of India, especially the rule related to 20% tax collected at source under RBI's liberalized remittance scheme has been facing scrutiny from HNIs. It is evident that when picking the destinations, HNIs usually prefer locations like UAE and Singapore due to the lower taxes and the long-term visa provisions.
They are looking to move to jurisdictions which have a better standard of living and get better security. So at first count, I would say Dubai, Singapore, Switzerland, Portugal. These are the countries that they look to move. I also feel that, these countries which offer special visa programs have benefited from this because that gives the individuals opportunities to invest and, become, have a proper visa to stay, get in and get out, which is obviously helpful.
And what effects will the large-scale private wealth migration will have on the Indian economy?
These small number of HNIs pay higher amount of taxes. So if they move out, obviously there will be a drop in the tax revenue collection. That is definitely number one. The second, many of these HNIs do a lot of investment because they have investable surplus in the real estate, startups and other businesses. And that investment may reduce because they would move to another country and the rules for investment back in India or their earlier country could be somewhat restricted given the present laws. Third one, which I also feel is very important, the HNIs of late have been doing philanthropic activities, particularly in higher education and health, and that may certainly dry up. Apart from these, they also have investable surplus because they would spend certain amount of money, and so they, to whatever extent they boost consumption and consumption at higher end, that would have some multiplier impact, be it for the goods or be it for the services.
The exodus of the ultra-rich is a disturbing sign for a growing economy. The migration of private wealth means loss of capital and a negative impact on tax revenue, wealth creation, and employment generation in India. Experts suggest it is essential to create a befitting environment both for individuals and businesses to prevent private wealth outflow.
Meanwhile, the US Federal Reserve's surprise hawkish pause of interest rate hike spoiled investors' sentiments back home on Thursday. Domestic benchmark indices slipped up to 0.5% after the US Fed projected 2 more rate hikes this year. Amid the rising interest rate scenario in global economies, will domestic equities face pressure in the near term? How should investors navigate this volatility? Lavisha Darad finds out in this report.
The surprise hawkish pause of interest rates by the US Federal Reserve snapped Dalal Street's 3-day winning streak on Thursday, June 15th. Domestic benchmark indices, the S&P BSE Sensex and Nifty 50 declined 0.5% and 0.4% respectively. After 10 straight rate hikes since March 2022, the Fed's rate-setting committee kept the benchmark lending rate unchanged at 5 to 5.25%. The US, though, signaled 2 more quarter points hike later this year, given their 2% target inflation. Analysts believe this could bring fresh market volatility in the near term, as the second rate hike forecast was not fully priced in.
In terms of volatility, we believe that there could be near-term volatility in Indian markets, especially on the back of the rally we've seen of late in the last 2 odd months. This volatility can be easily navigated because there would not be any liquidity pressure from global markets.
The Fed dot plot, a chart that estimates what the federal funds rate should be, showed policymakers expect rates to rise in the range of 5.5 to 5.75% by 2023 end. Half of 18 Fed officials penciled in the dot at that level, while one official pegged it to rise above 6%. As most global central banks, including the Fed, remain data dependent, analysts opine that more hikes could be in the offing if the inflation data disappoints. Apurva Seth of Samco Securities, for instance, said the chances of further rate hikes in 2023 are slim. US inflation at 4% is already placed below the US interest rates of 5.25%. Inflation is clearly on its way down, and Fed won't have to tinkle with rates unless there is a nasty surprise on the inflation front. That said, despite these rates hiked by the US Fed, analysts assert foreign flows into India would stay immune due to strong macros.
End of the tunnel is seen. So I think emerging market will be a place where they will like to invest. India is still attractive for anyone to invest. And whatever data we are getting, China has become a very difficult country to invest and take money away from them. So that way India is where you can make money. So India is a preferred destination according to me.
Overall, though analysts expect equities to experience some volatility in the near term, strong macros are likely to favor in the long term. Today, on June 16, global cues, foreign flows, and crude oil prices will continue to guide markets.
He's making plans for an early retirement. Business Standard.
The center recently announced that it will come up with guidelines for dark patterns on the internet in the next 2 months. The Ministry of Corporate Affairs and ASCI met with various stakeholders including Google, Meta, and Amazon to discuss these manipulative practices. But what are these dark patterns? Raghav Agarwal decodes it for you.
The Ministry of Consumer Affairs and the Advertising Standards Council of India, or ASCI, recently said they will develop guidelines to handle dark patterns on the internet within the next 2 months. They advised Indian companies to focus on self-regulation and discourage these practices in India. Separately, ASCI also launched its guidelines to curb dark patterns in digital advertising. But what are these dark patterns? Have you ever come across a pop-up on a website which is so big that you cannot see the cross button? Or a pop-up which asks you to sign up for a newsletter or any other service which does not close until you fill in the details? These are examples of dark patterns. Dark patterns are the unethical patterns a user interface designs to make your internet experience harder or even exploit you deliberately. In turn, they benefit the company or platform employing such designs. These patterns fall under the ambit of unfair trade practices and misleading advertisements of the Consumer Protection Act 2019. These practices are most commonly used on shopping sites. In discussion with stakeholders, the Department of Consumer Affairs and ASCI listed several deceptive practices considered dark patterns. These include charging hidden costs, creating a false sense of urgency to buy a product, sneaking additional products into a customer's basket, nagging a customer constantly for feedback, adding hidden costs, and showing fake ads, among other things. In India, misleading ads and unfair trade practices come under the ambit of the Central Consumer Protection Authority or the CCPA. According to the Consumer Protection Act 2019, a complaint alleging unfair trade practices or deceptive advertising may be sent to the CCPA or the District Collector or the Commissioner of the Regional Office. The Director General or the District Collector may then conduct an investigation or inquiry into the complaint, either independently or in response to a complaint or directions from the centre. If found guilty, a fine of 10 lakh rupees can be imposed on the manufacturer or endorser, potentially increasing to 50 lakh rupees for subsequent violations. The violator can also be prohibited from endorsing a product for up to 3 years. The upcoming guidelines by the centre will, however, be self-regulatory in nature. In the consultation, the centre advised online platforms to establish ethical design guidelines that discourage dark patterns. They can also encourage responsible design practices and independent audits to help identify and rectify dark pattern issues. The companies were also told to equip users with tools and resources that allow them to make informed choices online as another potential solution. This could include browser extensions, apps or plugins that detect and block dark patterns or platforms, providing clearer and more accessible settings and privacy options.
Backed by the nation's trusted bank, SBI, the banker to every Indian.
Well, that's all for today. For more news and analysis, please log in to business-standard.com. Thanks for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.